Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And we're back with Troy Cates from NEOS. Thanks so much for stopping by, Troy, during this crazy time, this crazy volatility, and hopefully we could all keep a cool head like you guys are doing at NEOS. How's it going?
Good. Thanks for having me. Happy to be on. And yes, it is a little bit of a crazy time with the increase in volatility and the markets selling off, the equity market selling off. So happy to be here and answer some of your questions.
For sure. And you guys are covered call experts and covered calls or covered call strategies, covered call ETFs, however you want to call it, typically shine during this time and typically get more attention and get even more popular, which is why I'm excited. And of course, prices go down, but as prices go down, yields go up as well, right? You could average down. So tell me a little bit, you guys have a very popular S&P 500 covered call ETF, SPYI, which is just under 3 billion, very consistent distribution rate at about 12% annually. Tell me how the volatility has been impacting SPYI or even QQQI, what you guys are doing. Are you doing anything special to mitigate this volatility in these strategies?
Sure. It's a great question because we've had a number of calls the past couple of days with clients and people that own the products. And when you
Uh-huh.
think about SPYI, what we're doing, we're long a basket of S&P 500 stocks in the same weighting. And then we have this covered call strategy using S&P 500 index options. And we're rolling that on a monthly basis. And one of the things that our models look at during that roll is, of course, volatility. It looks at where volatility is, the rate exchange of volatility, and a few other factors to decide not only how far out of the money those calls should be written, but also on how much of the notional should be written for the
You're writing,
portfolio.
yeah.
So to give you an idea, we roll at the end of the month. So the end of January, in the end of February, end of March. End of March, when we rolled right before this recent sell-off, volatility was high, much higher than it had been the previous 2 months. So the fund looked at it, the model looked at it and said, not only can we write calls further out of the money, but on much less notional than in the portfolio. So when we rolled it, give you an example, we rolled on about two-thirds of the portfolio. So about 65, 66%. Prior month, it was more like 75 to 80%. So when you think about that, you have a lot less of your portfolio covered by those short calls. So the way the model works is it's, trying to search for not only the optimal place to write out of the money and the notional to bring in that income, that consistent, as you said, 12% annualized income, but it's trying to figure out if the market does continue to sell off. It gave you a measure of downside, call it buffer because you're going to outperform by the amount of premium you bring in from those short calls when the market moves lower, which we've seen. But then if it does turn back around and move higher, it wants to make sure that we can capture a lot of that upside of the market move. Now, we've seen some wild swings over the past couple of days, yesterday, obviously today, and I'm sure the volatility will be here for quite some time as we work through this. But the idea with SPYI is we're not looking to do anything different just because these tariffs and everything else, the news cycle has been very headline dependent on what the market's doing. We are a rules-based systematic strategy that is going to roll at the end of the month. And yes, it can change how far to the money or on the notional that you're covered, but it's really not doing anything different at this point in time. We're watching the markets, but it has a really nice opportunity for upside growth if the market does turn positive over the rest of the month. And on the downside, it has outperformed by the amount of that income that we've brought in.
Yeah, it makes sense. So you kind of touched upon it there. So during times like these, you guys are actually able to write less covered calls, and that's because volatility is spiking, which means you're taking in more covered call premium. So like you said, not only are you writing further out of the money, correct? You said further out of the money,
Correct.
but we're
Yes.
writing less on the notional, which means you're covering less of the portfolio to bring in similar amount of premiums as, for example, a few months ago. And this keeps your distributions pretty steady because we know that that's why it's SPY and QQQI and your Russell one is one of the community favorites. Very consistent distributions. Not all perfect, right? Every single month, but they've been relatively consistent. So that's awesome, and that is by far the biggest fear for an income investor who's relying on these distributions. So what is your expectation or your I wouldn't say prediction of the next couple of monthly distributions? Are we looking at increases because volatility is higher? We know that back in 2022 there was that August month where you guys had a little bit increase of distributions. Are we looking at that, or what could investors expect with their distributions going forward or in the next little while here?
Sure. I mean, we don't know until right before we do declare the distribution, but with the increase in volatility, you might see a slight uptick. Like you said, there'd been months in the past where the distribution was a little higher on a percentage term. But again, the model moves every month to kind of have that dynamic part of it where it's aiming for that 10 to 12% annualized distribution rate for SPYI, for example. And right now it's sitting right around that 12%, that 1% a month or so. And it's moving on a dynamic basis month to month. So yes, it can be a little more, it can be a little less, but where volatility is, it gives the portfolio an opportunity to, as you were saying, as we were talking earlier, to write on less of the portfolio, which is really key for when the market does turn around. Whether it turns around tomorrow or in 2 weeks from now, it's important to make sure that that part of it is there, because we've seen these swings before where the market sells off for a month or two and then rebounds. We don't want to cap the portfolio and have you not participate with that upside.
Right, and that's why you're writing less of the portfolio. That makes complete sense. So when the recovery does come, whenever that may be, you'll capture a lot of that upside, which is typically very aggressive in a short amount of time. So I've been getting, from newer investors, maybe you could answer this because you guys are the professionals. And by the way, in case my audience doesn't know, you've managed the NEOS ETF, which you guys repatriated at NEOS. What I'm trying to say is you have a lot of experience, a lot of years of experience with options, writing call options. And I've been seeing this question more and more often recently, I guess, because of the fear and all the market volatility. Is it even possible for something like a SPYI or another S&P 500 covered call ETF to just stop the distributions completely? My answer is always no, because there's always going to be covered call income coming in. Do you see any scenario besides the S&P 500 going to zero, which we all know is like pretty much impossible? Do you see a scenario where you'll have to say, okay, we have to suspend the distributions?
We don't see a scenario where that might happen. I mean, there's always some extreme market event, like you're saying, that could potentially have, the ETF halt distributions, but there's no reason to, in our view. If you think about it, even if you had volatility really low, so we're used to seeing, the VIX in the 15 to 20-ish range. Right now, it's over 40, which doesn't happen that often. We haven't seen a close above 40 since COVID. And we had it the past couple of days. So if you think about that, that's a big event. But if you get volatility to come back in and it's sitting even in the single digits, which we haven't seen in a very long time, we'd still have enough income, like you're saying, off of those calls to be able to distribute on a monthly basis. So there's a lot of mechanisms within the model, as we were saying earlier, that can change to help bring in more income. And that could be writing on more of the notional, it could be writing closer to the money. But there's a number of things that happen on a monthly basis when those options are rolled to bring in that option premium.
Okay, sorry about that. There was a big video delay, but the audio was in touch. So that was okay. So let me just share my screen now. I like that answer, by the way. Hopefully that reassures people. And of course, we were talking a little bit about SPYI. This is your S&P 500 covered call ETF. You also have QQQI, the NASDAQ 100 one. And we all hear and we all know and we all say, covered call ETFs help to hedge volatility or the downside. And I actually did a total return comparison here with, let's start with the SPYI versus IVV, which is just the BlackRock S&P 500. And I started the time here. Well, actually, it's the wrong time. But if I do, the volatility pretty much started, not the tariff volatility, but overall volatility kind of started in February, end of February of this year. And if we just do a comparison, we see that SPYI is definitely doing its job. It has better performance than the S&P 500, right? It's down 15.36% in this short period of time, couple of months, while the S&P is down 17.52%, just the regular index fund. And I believe the same kind of story with QQQ versus QQQI, which is the NASDAQ 100, right? This time I did choose the right year. So as of February the 19th of 2025 of this year, until now, until the 7th, minus 18.57, but the Qs are down minus 21.35. So would you say everything is going as planned? These covered call ETFs are acting or behaving like they should be, which is during volatility or downside, and you actually see the graphs here, it's always a little bit higher, they're hedging some of that volatility.
Yes, I think exactly as you're explaining it to your audience. When we're selling those calls and bringing that premium in the flat to down months, like we're seeing right now, we're going to outperform by the amount of premium we bring in. So we're going to outperform the underlying reference asset, whether it's the NASDAQ 100 or the S&P 500. The idea, again, is when it does reverse and we start moving higher, we want to make sure we're keeping up and capturing a lot of that upside when the NASDAQ does move or the S&P does move, because we've seen it. It can be quick and it can happen fast. And we want to make sure we're there to participate with that. And if you go back in the history of SPYI, you've seen that month over month where we have these sell-offs and then we have these rallies back. We want to make sure we continue to do that and participate with the market. So yes, while these aren't hedged products, they will give you just a little bit of outperformance from that premium written on a monthly basis.
Right, right. So they're not designed to hedge, but they're designed, correct me if I'm wrong here, to do the covered calls, to provide that monthly income. It will hedge a little bit by nature. That's what covered calls do during a flat or down market. But I would say the primary objective is not to just hedge the S&P, right? It's more to provide that consistent income. Speaking of hedging, though, you do have products that are definitely more designed for hedging, which could, I would say, give investors who still want to be invested in the S&P 500 or the NASDAQ 100 a little bit more confidence. We discussed this before. There used to be a product called, or an ETF called NUSI, NUSI. That was the NASDAQ 100 hedged equity income ETF. You guys repatriated that to NEOS because you were managing it anyway. So you actually have QQQH, which is still the NASDAQ 100, like QQQI, but it's actually hedged. And you've recently launched an S&P 500 version, just launched. First distribution has not been declared. It's SPYH, great symbol, by the way, SPY hedged. So can you tell me how, for example, QQQH will compare to QQQI or SPYH versus SPYI?
Yes, of course. It's a great question. I think we've had a lot more calls on these funds over the past couple of days, thinking about what the market's been doing.
Not surprised.
So for QQQH, as you noted, it used to be the ticker NUSI. We were the sub-advisor on that product. When we proxied it over to us in late 24 and changed the ticker and the name, obviously, we also slightly changed the strategy. Whereas it used to sell a call and buy a put, and it had a model that kind of determined how far out of the money the put was. What we did was we decided to change it to a put spread collar. So we're selling a call still on up to 100% of the notional. Right now, to give you an example, it's about 75% of the notional covered. And on the long put side, on the long put spread side, it's 100% covered. So that long put spread will give you a measure of downside protection. So you think about it, if you're selling a call and it winds up being, depending on where volatility is, 2 to 3% out of the money, it brings in income just like QQQI would. We're taking a portion of that income and buying a long put spread that's going to give you a measure of downside protection, but still leave enough for a distribution. You can see the distribution's obviously lower than QQQI at 9% versus the 14% in QQQI, but you're getting that measure of downside protection. So in times like these, which we're going through right now, you're going to see some nice outperformance in QQQH versus QQQI. So you think about it, if you still want to be invested in the NASDAQ 100, you still want to get a monthly distribution, but you're willing to give up a little of that distribution for a measure of downside protection and a lower vol product, this might be a good product to take a look at.
So in simpler terms, or in simple, that was a very good explanation, by the way. I appreciate it. So essentially, you're not getting 14, you're getting a little bit less because you're taking some of that 14% yield and actually hedging it even more. That's how I
Correct.
see it. So you have even
Yes.
more downside protection, but hey, a 9% distribution, and of course that could vary. And on that side, do you see what's the consistency that you see with QQQH or SPYH versus SPYI and QQQI? Do you see similar consistency? I mean, QQQH has been around. If we look at the 2024, I see a fair amount of really nice consistency with QQQH as well.
Yes.
Just that now I see a big jump in the distributions.
Well, the jump is the fund actually did a reverse split. So it used to be around
Ah, okay.
it was in the 20s. We wanted to get it up to where kind of we launch all of our ETFs around the $50 range. So that's why you see the jump in distribution as far as dollars, pennies
The
per
yield
share.
percentage stayed the same.
Yes, but the percentage is the same. So that the goal for this product is that 8 to 9% distribution rate, sitting right here, right around 9. So the consistency you'll see there is very similar to our other products that we have a stated goal range. This one being in the really call it 8 to 9-ish range, while QQQI is really in the 13 to potentially 15 range. So this one will have a lower distribution because, again, like you were saying, you're spending some of that on the hedge that's going to give you a measure of downside protection with that long put spread.
Yeah. Okay. Thanks for. I did not know that. Thanks for answering that. And you heard it here. Consistent distributions, really the name of the game at NEOS. Do you expect SPY-H to be? My guess would be maybe 7 to 8, a little bit lower because the S&P is a bit less volatile.
So yeah, we will see it a little
Approximately.
lower. We can't actually, know until we have our first declaration and we see what that looks like towards the end of this month. But yes, it will be lower than triple QH just because again, the S&P 500's volatility is a lot lower than the Nasdaq 100. So we would expect a lower distribution rate.
Okay, and I'm assuming I don't know if you want to share some stats. For example, QQQH versus QQQI in the last couple of months. You could do
Sure.
that. I'll give you the ability to share your screen. But like you said, it is outperforming QQQI because you're having more downside protection. So if you have any stats or anything like that,
Yeah, I
you can
could
do
pull
that.
up, let me see if I could just share my screen with you and see if that's the right one. I have up here just a little comparison from, I think the date you had was the close of the 18th of February
Yeah,
to April 7th. And you could see the NASDAQ 100 down 21% total return. QQQI, as you were saying, down about 18 and a half. Triple QH down 1386. So
there you
really
go.
nice outperformance. And that comes really from that long put spread, that hedge that has helped the product during this time where the market just continued to sell off and it obviously accelerated over the past couple of days.
Awesome. So even more of a buffer, even more of a buffer during the bad times, I call them, or the volatile times. And this is what I love about the industry now, or the covered call ETF landscape. You got so many options. A lot of people are confused by all these options, but you could also mix and match, right? There's nothing wrong with mixing or matching a QQQI with a QQQH, and you choose the percentage that you have the stomach for, right? That makes you
Yes.
sleep well at night. For me, as a passive income investor who just stays in the market, that's really what I love about these types of ETFs. They allow you to stay in the market forever. Essentially, if you're just living off the income and then the amount of volatility or the swings of capital, what your capital does, you could adjust your portfolio with the products you choose. So it's really cool that you guys have, your standard set of covered call ETFs for the indexes, but you have another one that's even more hedged. I think that's really awesome. And just for the record, you're still doing that a monthly type of strategy. There's no zero DTE or anything, daily calls added in here or anything like that for now.
Correct. This is still on all the products we talked about today. They're a monthly roll. We roll at the end of the month. Duration is a little longer than that month, but we're still closing them out at the end of the month with a couple of weeks till they would have expired. So we found that's the best way in these types of products to capture the most premium that you originally wrote in the fund. So for us, it makes sense. It also allows for our model to dynamically choose and pick how much of the notional and how far to the money. And yeah, we have not moved away from that as of yet.
Awesome. Okay. And you guys don't just have index-based funds, right? Of course, you have your three high, your equity high income. You got the hedged ones with the S&P just recently being launched. You also have some alternative stuff. You have a Bitcoin covered call ETF, even a real estate one. The U.S. market, in terms of covered call ETF, has been dying, I know, for a real estate. So these are, pretty high quality REITs in the US with a covered call overlay. You recently launched also a TLTI, right? The covered
Yes.
calls on the TLT ETF. So a lot of products to choose from, even some in the bond world. Would you say that for income investors, evaluating NEOS, that one of the most important things is distribution consistency across all these products? Can investors across all these products really expect more or less fairly consistent distributions? Is that a top priority at NEOS?
I think if you think about NEOS in general, we stand for Next Evolution Option Strategies. It's all we focus on is these option-based income ETFs, and we're trying to deliver you monthly income in a tax-efficient manner. So whether that's through the S&P 500 and having that goal of that 10 to 12% annualized range, and it'll
Yeah.
fall somewhere within there, or if it's looking all the way over into our enhanced income U.S. Treasuries with CSHI or TLTI. That enhanced means we're trying to give you a little bit of income over whatever the underlying, whether that's the 1 to 3 month T-bill in CSHI, or that's the 20-year plus in the TLTI. We're trying to give you enhanced income. So using different strategies there, that's a weekly trade, that's on a weekly sale of put spreads. So very different than the covered call products. So we have a bunch of different products as you kind of walk through, and we really look at ourselves as a solutions provider. So if you're looking for income in the equity space, or maybe
Hmm.
you're a little more concerned about these markets and want to be in the hedged or fixed income space, we try to just find a solution that might fit for you, where we can give you some added income off of that underlying reference asset, where you can continue to invest your money.
Yeah, I mean your lineup is growing. You guys are obviously growing as a firm, and even CSHI is also community favored as a cash alternative. This is short dated bonds with a little bit of options in there as well to really give you a little bit more than high interest savings. That's what it's called in Canada, but CDs, or I believe it's called in the US. This is about 5 to 6% yield here. So this
Yep.
is a good cash alternative. So I really like that you guys have a full lineup of whatever the investors need. And I'm not going to ask you about what's coming next in future products, because I know you're not allowed to talk about that. But to my audience, and as well as this channel, we'll always keep an eye on what NEOS is doing, what you guys are doing. You're doing great work for the income community. And as usual, I really enjoy having you on to talk about your strategy and your new products. And hopefully there's more soon, and you'll come back to the channel. So thanks, Troy. I really appreciate your time.
Thank you for having me.